Realty Income is a strong company and maybe one of the most durable REITs across the board. The real estate company is very well diversified, has a tenant base with an occupancy of around 99%, which is outstanding. So then why exactly has the monthly paying dividend stock, ticker symbol O, been so beat down over the last year? And is this potentially a massive buying opportunity for dividend growth investors? Well, in this video, we are going to do a deep dive into Realty Income and uncover a lot that I am sure you have not seen anywhere else. So stick around because we are going to be going through all that and more. Right after you, please drop a like on this video and subscribe for more future content like this. So first of all, just to get everyone on the same page, let's go through a really brief background on Realty Income and see a little bit more of what the company is all about. Realty Income got its start in 1969 with a single investment in a Taco Bell. And now today, this REIT owns thousands of properties across America that are leased to hundreds of tenants operating in dozens of industries. Retail properties account for most of Realty Income's rental revenue, with industrial warehouses generating some of the additional. Now, all of Realty Income's properties are under a long-term triple net lease agreement, which means that the tenants pay for things like maintenance, utilities, and even taxes. Now, impressively, Realty Income has paid uninterrupted dividends since the firm's founding and has increased dividends each year since going public in 1994. But stay tuned because we are going to look closer into the dividends in a little bit. To look a little bit deeper into Realty Income, going on the website, they have over 13,100 commercial properties under the net lease agreements, a 99% portfolio occupancy, which means basically, for the most part, every single one of their properties are being leased right now. Over 1,300 different cities and 85 different industries. This is a high quality REIT that is heavily diversified. Now, what's also crazy about Realty Income is that a lot of us actually step foot in Realty Income's properties, a lot more than we probably even realize. Realty Income leases to companies like Dollar General, Walgreens, Dollar Tree, 7-Eleven, Wynn Resorts, FedEx, LA Fitness, and many, many more, just to name a few. Now, this right here is maybe one of the most bullish aspects of Realty Income, in my opinion. It's the fact that the property diversification type is made up of mostly retail. Now, especially knowing the type of tenants that Realty Income leases to. These are tenants, these are businesses that are going to be around, whether the economy is good, whether it's bad. It doesn't get much better than leasing out your properties to recession-proof businesses. Now, of course, one of the main reasons on why most of the real estate industry is under some pain right now is, of course, because the Fed has been raising interest rates for well over a year now, with interest rates over 5% compared to the 2 or 3% that we saw just a few years back. This is, of course, putting a lot of pressure on real estate investment trusts because, once again, they do utilize a lot of debt to buy properties, and of course, the higher interest rates are, the more expensive the debt is to obtain. Realty Income is the largest net lease by asset size and has a very strong track record of delivering shareholder returns. This is reflected by its 14.2% compound annual total return since the IPO date back in 1994. So 14.2% compound annual return is not too shabby at all. It's also the only net lease REIT to have an A-, A3 credit rating. And the more and more research you do on some of the more popular REITs, you might be surprised on how low some of the credit ratings are for some of these popular REITs. Now, Realty Income is also one of my favorites because it produces strong growth over time with less volatility than the market average, with a beta of just 0.5. Now, I can't speak for everyone, but for me as a dividend growth investor, I like to have my portfolio at a somewhat low beta average. Because with my personal risk profile, I just can't stomach some of the massive swings that some of the more growth-focused stocks or ETFs have to offer. And that's why Realty Income is a big portion of my portfolio, making up well over 10% as of currently. Now, digging a little bit deeper into Realty Income's quality tenant base, with 3/4 of annual base rent stemming from non-discretionary, low price or service-oriented retail, and other 15% being non-retail. This adds up to 91% of Realty Income's rent being either economically or e-commerce resilient, or like I like to put it, sort of recessionary proof. Now, next, I thought it'd be interesting to look through the last earning results from Realty Income. And although these earning results ended in June 30th of this year, of course, I still think a lot of these company highlights are definitely relevant to give us an idea if or if not Realty Income could be a buying opportunity and a fundamentally strong company REIT moving forward. So the company highlights from the last earnings report, it says for the 3 months ended June 30th, 2023, the net income available to common stockholders was $195.4 million, or around 29 cents per share. Normalized FFO available to common stockholders was $688.3 million, or $1.02 per share. AFFO available to common stockholders was $671.7 million, or $1 per share. Invested $3.1 billion in 710 properties, and properties under development or expansion at initial weighted average cash yield of 6.9%. On top of that, Realty Income raised $2.2 billion from the sale of common stock, primarily through the ATM program, with a weighted price of around $61.89. Issued $400 million in 4.7% senior unsecured notes due December 2028 and $600 million of 4.9% due July 2033. Now, the net debt to annualized pro forma adjusted EBITDA was 5.3x%. Completed the previous announced sale-leaseback transaction with the EG Group of 414 single-tenant convenience store properties for $1.5 billion. Also very important, some CEO comments. The CEO said, "I am pleased with the results our team delivered in the second quarter," said Summit Roy, Realty Income's President and Chief Executive Officer. "Our performance continues to be driven by our diverse, high-quality portfolio of leading clients. Our global pipeline of investment opportunities with favorable risk-adjusted return profiles remain active. During the quarter, we closed $3.1 billion of investment volume, and we continue to evaluate to expand into new geographies. Our investment efforts are supported by our well-capitalized balance sheet, which was further bolstered through a successful debut Eurobond offering back in July. In addition, we currently expect over $650 million of net proceeds from unsettled forward sales of our common stock to support our near-term growth initiatives. Given the current liquidity position and healthy investment pipeline, we are increasing our acquisition guidance over $7 billion. Combined with our well-performing real estate portfolio, which finished the quarter at 99% occupancy rate, our business returns position to investors, consistent cash flow, and compelling risk-adjusted returns. Now, with all this good, there are still some potential risks moving forward for Realty Income, and this includes a potential recession, which of course pretty much puts all different companies of all sizes at risk. But because of Realty Income's tenant base, and like I talked about earlier, most of them, in my opinion, being sort of recession-proof, plus the fact that Realty Income's tenants made it pretty well through 2020, shows a rather promising future ahead, no matter what happens in the economy next. Now, on top of that, another risk is, of course, the potential for continuous higher and higher interest rates, which would make the cost of Realty Income's growth much more costly and could even pressure the bottom line as different debt gets closer and closer to refinance dates. However, higher interest rates could also force higher levered owners of properties needing to sell, maybe allowing Realty Income to pick up some properties at fire sale prices, therefore kind of keeping things in a balance, because higher interest rates a lot of time lower the potential cost for new acquisitions, which is again why I personally don't really see a near-term problem in the growth of new acquisitions for Realty Income. So where do we go from here? Is Realty Income currently a buy at the current levels it's at? Well, it's been flirting with a new 52-week low over the recent trading days. Well, Realty Income, in my opinion, represents a massive value for dividend growth investors like myself, with a safe starting dividend yield of over 5%. Realty Income has a very strong track record, has a well-diversified portfolio, and has a path to acquire more and more high-quality companies. And Realty Income's balance sheet, I think this REIT is going to be just fine, no matter what the economy throws at Realty Income in the near term. But I want to hear from you guys down below at these current levels. Is Realty Income, in your opinion, a buy? Or perhaps are you sitting on your hands and waiting for a better opportunity out of Realty Income's share price? If you enjoyed this video, make sure to please drop a like in it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.